Sounds good. Welcome, everybody. Thank you for joining us. I think if you noticed right away from our historical name of boardrooms, we recently have rebranded the name of our monthly boardrooms, and they are now called Thrive Talks, which Noah and Peter are about to explain in a second. But today we're going to be talking about the 2026 estate tax surge, what that means, what's going on, and what you can do as an attendee to actually protect your wealth. But before going into estate tax planning and the changes coming up, I did want to pass it to Noah and Peter to talk about why we're calling this Thrive Talks, what that logo behind you is, Noah, and what Wealth Thrive means for the community and for the future.
Awesome. Thanks, Samir. I'm really pleased to announce the formation of Wealth Thrive. Wealth Thrive is a new entity that we formed specifically to help seven-figure income and eight-figure net worth entrepreneurs develop their tax strategy. What we found in our experience at Freedom Family Office is that that's really a unique specialty that we offered to the marketplace that wasn't readily available. A lot of the entrepreneurs that we were working with were relying on their accountant to develop their tax strategy. And unfortunately, a lot of the accountants that are in that marketplace of preparing tax returns, their business model doesn't incentivize them to focus on tax strategy. And we've found that filling that role for our clients has been incredibly valuable. The challenge as a family office, as a registered investment advisory firm, is that we can't collect testimonials. We have certain advertising prohibitions because we're regulated by the Securities and Exchange Commission. And so we decided, in an effort to expand our services, expand our reach, and serve more clients, we wanted to exclusively provide these tax strategy services without any regulatory oversight by our registered investment advisory firm for clients where we're not actively managing their stock and bond portfolios. So Wealth Thrive is a standalone company here to provide tax strategy, personal wealth coaching services to entrepreneurs. And we're excited to share what that's going to mean to all of you, including talking about estate taxes. Maybe, Peter, you've got a little bit more to add.
Yeah, two things. One is I'll just sort of pivoting on what you've been talking about. Look, we need accountants in the world, what we call tax preparers, but we think just as importantly, you need tax planners in the world, tax strategists. That is one of the key activities of Wealth Thrive. I was in Nashville last week doing a presentation about taxes to a very high net worth group of business owners. And sort of toward the end of one of the presentations, a guy jumped up and said, how can it be that the people in this room who could have access to the best talent in America have never heard of any of the ideas you just talked about? And everyone in the room nodded their head. So I think there's an opportunity to bring to those of you on the phone interesting, timely updates about taxes. It's a little hard to read over Noah's shoulder there, but Wealth Thrive, the little tagline below that is pay less tax, have abundance. And I think there are two great ways to get wealthy in America. One is start a business, make a lot of money, save the money. But it turns out that just as powerful a way to grow your wealth is to pay less taxes. And today we're going to talk about one of those taxes, pretty much the biggest one, which is estate taxes. So I'll pass it back to Samir, and he'll be the maestro here as we kind of walk through the outlines of what's coming in the estate tax surge.
Thanks, Peter. Thanks, Noah. It's super exciting. And we unshared our screen so you can actually look right behind Noah's screen, but we're going to dive right into the topic. So Noah, if you go to your slide on exemptions, I think to set the stage here, before getting into sort of the tax surge and what that means, I think it'd be important to understand the landscape. So Noah, can you walk us through the current estate and gift tax exemption amounts and why the reduction in 2026 matters?
Sure. So many people, we're going to kind of go through a lot of the basics today. And obviously, if you have more questions about your personal situation, we're here to help answer them. We'll have some time for Q&A at the end. But in general, after someone dies, their assets that remained in their name, in their estate, are going to be subject to another level of tax. So yes, you paid your ordinary income tax while you earned your money. Yes, you paid your capital gains tax when you profited from the sale of your business. But if you have more money than the government wants you to have, when you die, they're going to tax you again. And so presently, if an individual dies with more than $13.61 million, that estate is subject to a 40% federal tax, and certain states have additional state tax. Now, barring any changes from whomever our next president is, the estate tax law is scheduled to go down to about a $7 million exemption per person in 2026. So there's another exemption in addition to the primary, big number, is you can gift $18,000 per person per year to anybody you want. So that's an annual gift amount, and then this is your estate exclusion amount, and you could use this lifetime exclusion anytime in your life. So if you don't use your 13.61 million in 2024, or maybe it'll be about 13.9 million or maybe even 14 million in 2025. If you don't use it, then you want to use it in 2026, the number is going to be about 7 million. It's going to get cut about in half.
Right. And I think maybe we just use some quick numbers. Imagine an individual had an estate of $10 million, and they may be sitting there thinking, no issue, right? The exemption's $13.6 million. I'm under $13.6 million. I'm good to go. Well, on January 1st, 2026, that number is going to be about 7, which means about $3 million is exposed, not even counting for appreciation. The estate tax at the federal level is somewhere between 35 and 40%. And if you live in a state that has a state estate tax, you can see that without taking action now to get yourself under what will be the exclusion amount, you could end, and it's going to be a use it or lose it. It's going to come down. So you want to take advantage of it.
One of the other things I'd add is that, none of us know when we're going to die. And so we can only base our estate tax planning strategy on what exists today. It's possible that in the future, the exemption could be 0. That's not unlikely in a way because of our large federal deficit. The government may decide, hey, if you die with any money, we want a piece of it. Well, we also don't know what the tax rate will be. So right now it's 40%. Maybe it's going to be 50%. Maybe it's 60. Maybe it's 80. You really never know. And as my friend Chris always alluded, it's like a hurricane. And right now, we're like at a category 1. This is as good as it's been in a long time. So, you've got this major exemption. You could get all this money out of your estate. Well, we know it's turning into a category 2 in 2026. So you could do nothing and wait until landfall. But what we would encourage you to do is consider your planning now, even if you're under that $7 million per person amount in 2026, you might want to evaluate when I die, if that might be 30 or 40 or 50 years from now. Well, what's your estate going to look like then? And if you could exempt your estate from tax now, then it's an optional tax. So you're making a decision, if you don't do your planning, that you're willing to put your estate at risk for future taxation.
Right. That's helpful. Thank you, Noah. I think going next, we're going to talk about generational skipping transfer tax. So, Peter, how will the reduction in GST exemption impact multi-generational wealth transfers?
Yeah, so a little 101 there. So the tax that we've been talking about right now is, for example, the tax that would be assessed if an individual or a husband and wife left assets to their children. And a great trick used by some of the great fortunes that were built in America was they said to themselves, well, my kids are already rich. They don't need any money. So I'm going to leave all my money to my grandkids, thereby skipping one level of estate tax. Well, the government caught on to that, and they have instituted a separate tax called the generation skipping tax. So if instead of myself leaving stuff to my kids, I leave it to my grandkids, that's a separate tax. The good news is there's a separate exemption for that, which is the same amount. So as you begin to think about this, one of the things you need to analyze is whether or not you are, or it might make good sense, because a flip side of saying what I'm saying is you are allowed to skip a generation, but only up to the exclusion amount. And if, depending upon your level of wealth and your needs and your kids' needs, it could make sense to skip a generation. Now's a good time to act, because the amount that you can use to do that is the same 13.61 million. Probably one little thing we should mention here, that's an individual exclusion. A married couple has double that amount. So if you think about that, for very wealthy people, maybe to use the same math, let's say you had an estate that was 20 or 25 million. Well, it'd be under now a combined exclusion of about 27 million. But if it goes to 7 times 2 is 14, now they're over. So just there's some urgency. And I think we'll get into this a little bit. It may seem like on October 17th of 2024, January 1, 2026 is a long way away. It's not, in terms of analyzing this, implementing it, getting the documents done. So it's good to begin to have urgency around getting going on this.
Thanks, Peter. Yeah, that's helpful to understand. Now, if you look behind Noah's screen there, talking about the actual tax increase, Noah, if I'm in the audience listening in, what should I do if I have a larger than expected estate tax in terms of that? And if I don't take action, what happens?
Yeah, so just going through the numbers, again, if the exemption is reduced in half, it's about a $7 million reduction. There's a 40% tax on that additional amount. So it really amounts to a $2.8 million tax increase for each person. So if your family, let's say, has a 50 or $100 million net worth between a married couple, well, this would be a $5.6 million tax increase on your estate. Again, the estate tax is a tax that, unfortunately, a half of Americans don't even have a will. And, among our client base, I would say 80% have a will when they meet us, but still 20% of high net worth individuals do not have a will. A will is just going to direct where your assets go at death. The estate planning that we're recommending is one step beyond creating your will, your healthcare proxy, your durable power of attorney, the main documents that you want to have in any estate plan, regardless of wealth. What we're talking about is finding ways for your family not to be exposed to this estate tax, no matter what it is when you die. Because again, we don't know when you're going to die. We don't know what the exemption amount will be when you die. We don't know what the tax rate will be when you die. But what we do know is we have an opportunity that hasn't existed in the past, where a married couple can give $27.5 million to their beneficiaries without having to pay a dime. And we could take advantage of that. And we'll talk about some ways that you might take advantage of it without necessarily giving up access or control to your dollars.
Right. Now one follow-up question on that, Noah. So just so people can understand the visual. So on that hike, I face potentially a 40% tax on that.
40% tax on the amount over 7 million in 2026. Yeah. And again, we don't know what the laws are going to change to. We just know if the government doesn't change the law, that's what's going to happen on 1/1/2026. It's possible the next president can change the law. It's possible they won't. Neither candidate has really made the estate tax part of their platform or talked much about it. In the prior election, Sanders was really vocal about reducing the exemption amount to $3.5 million. And there was a lot of thought among the estate planning community that if Biden were elected, he may kind of take on Bernie's desire and reduce the exemption amount to 3.5. They decided it wasn't worth the political capital because they knew that it's going to automatically reduce to 7 on its own in 2026. And so I don't know that either candidate is going to want to make a change to this particular law. I don't know that there's enough incentive by either party to want to change it. So I don't know that it's ever going to get better than it is today.
And I know we're about to dive into strategies on what we could do to help, but if I am listening in, is this something that I should be acting on now? Can I wait a little bit? How urgent is this?
So I think it's a two-part process. Is the first part is to look at the documents that you have right now, and obviously we'd be delighted to help and assess how those documents would operate under the current regime and how they might operate under a new regime. A lot of estate planning documents have provisions in them that are keyed to the exclusion at a certain time. And and it just refers to the exclusion. I can give an example. I know a situation where, because of the high exclusion and the high net worth of the person, the estate plan essentially says, leave the exclusion amount to my family. That would pass tax-free. Leave the rest to charity. So right now, the numbers would be something like, this person is single, 13 million would go to her family, but about another 13 would go to charity. If nothing changes in her documents, but the numbers come down, now she's going to leave 7 to her family and the balance to charity. So so-called formula funding clauses need to be looked at. That's kind of phase 1. And then the phase 2 would be, okay, what should I do about all of this if my current documents are not going to protect me from the reduction in the exclusion?
Got it. That's helpful. Thank you. So let's dive into actual strategies to help. How do you think, Peter, lifetime giving can help reduce the estate tax burdens in the future?
Yeah, so we'll kind of, I guess, climb the ladder here from the most simple to somewhat more complex. So if you gift assets out of your name, often done either directly to children or, as we talked about before, grandchildren, or sometimes in trust if you want to protect those assets, ownership breeds taxation. So if you transfer the ownership, give your kids some money, put some money in a trust for your kids, those assets, as long as the gifts are irrevocable, those assets are off your balance sheet. And going back to what Noah said, they would not be included in the estate tax calculation. Well, the dichotomy is ownership breeds taxation. And if you move the ownership, there's no taxation, but ownership also breeds enjoyment. And so if you move the assets out of your name, whoops, wait a minute. How do I get to use those assets? Are there strategies I can use where, from an estate tax standpoint, I move the ownership out of my name, but I may get to enjoy the assets? And there's a couple of those, and I think Noah's going to walk us through one that we use all the time with our clients, called a slat. So Noah, unpack for our audience the slat.
Yeah, before we get there, I want to talk a little bit about the outright gift versus a gift. So I mentioned there's 2 parts to the exemption. We have the exclusion amount, 13.6 million, going down to 7. And then we have this $18,000 per year. And a lot of affluent families decide to make an outright gift of the $18,000 per year. So Christmas time or birthdays, they might write a check, a married couple, for $36,000 to their child, or maybe to their child-in-law, or maybe to one of their grandchildren. And that money is really just transferring from their estate now to their children's benefit. And the idea is that their children are going to use it. So they may use it to invest in something for their future, but they're using it in a way that impacts their life positively right now. And one of the authors that I really enjoy his writing on this topic, his name's James Hughes Jr. He's a 7th generation lawyer, and he's been advising, the real ultra affluent families, 9-figure net worth and 10-figure net worth families. And he talks about the distinction between a gift and a transfer. And so it's very common that these $18,000 checks, they're gifts. We're giving them to the recipient. The recipient knows that they're receiving them, and they're going to use it to benefit their life. They're either going to spend it on something that they wouldn't otherwise be able to afford, or they're going to save it so that they have greater comfort and financial security. But when we go to gifts to trusts, oftentimes those are more of a transfer. They're motivated for tax reasons. And when you make a gift to a trust, the beneficiary of that trust may not even know about it at the outset. And so, that is a design when you're shifting assets from your individual name into a trust, and that trust may be for the benefit of your kids or grandkids or great grandkids or nieces and nephews. That is really an asset transfer. And one of the adages that you may have heard of is called shirt sleeves to shirt sleeves in 3 generations. And what that means is that many families who accumulate wealth, unfortunately, 70% of them will not have any of that wealth by the 3rd generation. And another, it really gets to 90%, won't have it in the 4th generation. And the reason this happens, and they call it clogs to clogs in Holland and rice paddy to rice paddy in China, because it happens all over the world, is partly because these are transfers rather than gifts. And so what we encourage families to consider is when they're making a transfer, how do they really inspire it to be a gift? A gift is something that we're giving with an open heart, with love, with caring, and with communication. Because the main reason that families of wealth don't transfer that wealth from generation to generation is not because of poor planning. It's not because of poor investment decisions. It's really because of a lack of communication and trust. There's a silence and a secrecy associated with these trusts that they're creating. And oftentimes they're not discussed with the beneficiaries until there's a milestone event. And at that milestone event, the beneficiary is informed that they now have access to a pile of money. We discourage that highly. And so outright gifts are often clearly made with, the beneficiary in mind. They're receiving the check. They're going to use that check. If you're going to make a gift to a trust, then the next thing you're going to decide is, are you going to inform the beneficiary now or later? If you're going to inform them later, maybe it's because they're a minor. Maybe it's because you don't want to influence the outcome of something in their life as they're developing into young adulthood. But typically, we're encouraging you to discuss this as early and as often as you can with the family members that are going to receive the benefit. And these trusts may provide your beneficiaries with current benefits, so they may be able to access the interest or principal of the trust for their most commonly called HEMS needs: health, education, maintenance, and security, or it could be for more than that. And so anytime you're using a trust structure, you want to be clear about what the beneficiaries are going to receive from that trust. And as Peter alluded to, the most popular trust among married couples that we're using right now is called a SLAT, S-L-A-T, and it stands for Spousal Lifetime Access Trust. And the reason it's so common is because if Peter and I were married and I created a trust for Peter, well, he could access that during his lifetime. And if Peter set up a trust for me, I could access that during my lifetime. And in contrast, if the two of us set up a trust for, let's assume Samir was our kid, well, now we can't access it, only Samir can. So the Spousal Lifetime Access Trust gives us the ability to still access our funds while we're alive without having to transfer it 100% to another generation.
Yeah, that's very helpful. And at our company, we help clients implement those strategies like the Dynasty Trust, the slats that Noah's talking about. Peter spoke a little bit about charitable giving, which we'll get into. But what if I'm somebody that's listening in that hasn't even done anything with estate planning, but I want to take advantage of those current exemptions? What would I do then? Any recommendations from you two?
I mean, call us. And I don't mean that facetiously. We, prepare a balance sheet of your assets who owns them? Are they singly owned? Are they joint owned? We'd be delighted to walk through. This is something I spend a lot of time. We're shocked, actually, how many clients we meet for the first time of substantial wealth don't even have a will. So we're very active in first educating them, really in the same way we are today about the landscape, motivating them to do this important work. If they don't have an attorney, we can help find them one, and we can kind of walk side by side with them from today to an estate plan that both distributes their assets the way they want to, but minimizes taxes as much as possible. And I would say that's a classic Wealth Thrive activity, right?
One of the other things I would share, Samir, is on charitable gifts, because we didn't get a chance to touch on them. So oftentimes for families that are making annual gifts to charities, they might decide to pre-fund all of their future gifts by funding some type of charitable trust. And charitable gifts not only provide you with the benefit of reducing your estate, but you also get an ordinary income tax benefit because charitable gifts are deductible from your ordinary income tax. So the tax that you're paying annually on the income that you're earning, you could reduce that tax by making a charitable gift. So in the case of a family that, let's say, has a desire to maybe gift $100,000 a year to the causes they care about, they may decide to fund many years of those gifts all at once. They reduce their estate, and there are lots of strategies you could use where you may get a tax benefit, and in addition, you can get an income stream that's coming to you while you're alive, with the balance going to a charity at death. And those types of strategies, and maybe Peter, you want to give an example or two, but
sure.
those strategies can be really helpful.
There are two that are the most common, and the technical word for both, which I'll explain, they're called split interest gifts. So the first most common one is called a charitable remainder trust. So I take an asset, I give it into a charitable remainder trust, I get a deduction for that. Often I would give to that trust a highly appreciated asset, which I can sell inside the trust for no capital gains because it's a charitable trust. And I receive during my lifetime an income stream from the trust. And then whatever is left over after my lifetime or a set number of years goes to charity. So back to that, not directly analogous to a slat, but it's a way to get some assets out of your name, but still enjoy them. The flip side of a charitable remainder trust is what's called a charitable lead trust. So I put some assets in a trust, the charity gets the money first, but what's left over comes back to my family. So those are two things that can make good sense. And I'm thinking it isn't on the screen, but maybe one thing we might mention, and apologies if you're not familiar with this world, but the world of estate planning is a world of acronyms. So SLATs, CRUTs, CLATs. Another very common split interest trust is something called a QPERT, Qualified Personal Residence Trust. And many of the people on this call probably, it could be that one of their most valuable assets in their estate is their house, depending upon where they live. And essentially what you can do with the QPERT is put your house in a trust, but retain the right to live there for a certain number of years. And then the house would go to whoever you designated as your heirs. Now, because you retain some of the enjoyment, you're not going to get out of your estate the full value of your house. You're going to sort of get out of it the discounted present value of giving it away in the future. That's a mathematical calculation all set out by the IRS. But I think the point here is there are lots of things that you can do other than outright gifts, either to people or to charity, using trusts that allow you to both get some tax benefits, but to retain some enjoyment of the assets, and all worth considering in the right situation.
That's helpful. Thank you for that. Noah, if you want to go to the next slide.
There you go.
So we obviously spent some time talking about strategies, and in a little bit, we're going to actually answer some questions too. So if you are in the audience and you have some questions about some of the amazing insight that Noah and Peter are sharing, please go ahead and start posting the questions, because we are going to spend time taking those questions. But we spent a little bit talking about, Peter, like irrevocable trust, dynasty trust, slats, and all these other terms that are used in estate planning. And, you know, with our firm, we talked a little bit how we can help and set up a meeting, but is there anything else you two would share maybe on what we would do sort of after this call if we set up some time, how we can be the best partner at Wealth Thrive for potential people interested?
Yeah, I mean, I think the outline there is essentially what we've said is either you have a plan or you don't.
Right.
If you have a plan, let us review it and think through for you what would be the consequence if you made no changes in your current plan and the exemption came down. What action should you take either to change the plan or to move assets around to get under the exclusion? And you know, that's a combination of, I guess, being a thought partner, an educator, and a motivator. I say all the time around our company that everything we do is a math problem. So there's a lot of math in here, and we can help you understand the math. But I think part of the whole concept of Wealth Thrive is to be, not a particularly glorious term, but to be a project manager. We're not just going to give you a do-it-yourself manual. We're going to help you do this and get from where you are today to where you need to be. And I think while the rules are applicable equally to everybody, the customization of those rules to each individual family situation is very different. And so I think we can help you kind of line up your personal situation and desires and family members with the strategies that would make the most sense for you.
Yeah. And you can go to talktofreedom.com and fill out a form, or you could email Peter or myself.
Yeah.
Our team will post our emails in the chat, and you can email us directly as well. We're going to share our screen again because we're going to open it up for questions now. I do have one more question, but I want to open up to announce our next Thrive Talk that we're having next month, which is a really important one. But before getting into that one, I did want to ask you, Peter, a question that is top of mind for a lot of people, a lot of business owners in general. It's no secret the 2024 election is coming up here and could potentially
Can't wait till it's over personally, but that's just my own personal opinion.
A lot of people are nervous, understandably, right? That is sort of up in the air. And I'm just curious, with the 2024 election, would results of that election impact any sort of estate planning decisions, especially if one of the two candidates maybe changes things on the tax policy side?
So, I mean, the short answer to that question is yes. I think the issue is that result is not likely to happen very soon after the election. It would be an elongated process to get through two houses of Congress if we continue to have a divided government. So I think the message there is, which I think Noah alluded to too, is you don't want to wait. And, you know, better to be prepared in advance. The good news about a lot of these planning that we do, they can be modified, but I wouldn't, the fact that we're going to have an election in 3 weeks doesn't mean in 4 weeks all these rules are going to change. It would be a long process to get them changed. And as Noah said, it hasn't seemed to be in either party a big issue. I think that they're much more focused on issues other than a tax regime that mostly infects a tiny portion of the population.
Thank you.
We had a question in the chat around, you know, if you plan to live and you plan to live kind of beyond whatever the current tax code might be or the 2026 tax code might be, how do you future-proof your plan? And
yeah.
I would say kind of two parts to my answer. The first is that when you're developing your estate planning documents and you have young beneficiaries, I like to think just in like 5-year increments, because if you're or 10-year increments, like if you have kids that haven't gone through their education, just think about what you want to happen if you were to die before they finish their education. If you have kids who finish getting educated but aren't yet married, just think about, what would you want to happen in the event you die before they're married? When you have kids that are married before you have grandkids, think about what would you want to happen if your kids had grandkids. And then when you have your grandchildren, hopefully you're able to think through, what would I want for my kids and grandkids if I died unexpectedly? And so the reason why I think it's helpful to only think a few years in the future is because too many of us, when we're doing the planning, we're trying to think through every single possible outcome of our children, of our children's spouses, of our children's children. And, the odds that all of them are going to be of the type that we hope them to become is probably small. And so often in estate planning, we're trying to account for all the things that might happen in someone's life. And that may prevent us from taking action to having documents that make sense to have now. So I always would encourage you, think more closely about what this next stage of life is. What if something happens to you before you hit the next stage? The second piece, which is kind of the longer term, okay, I put my SLAT together. I'll give you my example, right? I've got young kids, they're high school and middle school, but I set up a SLAT for Amanda, my wife, a couple of years ago. Well, the documents that relate to the distribution of those assets are able to get changed during my lifetime. Right. So they can always get amended, but I've already done the most important work of taking all the assets out of my estate so that they won't be subject to estate tax no matter what the law becomes. So if there's zero exclusion and 100% tax, and the government says when you die, we take everything you own, well, my family wouldn't be impacted by that because I've already done the planning. Now, maybe there will come a time where what I want from my estate documents, from the trusts that I've created, change. And right now, by way of example, my children never receive an outright distribution of a large sum of money from that trust. So the trust never ends with a distribution to my children. There may come a time when they're in their 40s and I'm in my 70s that I would rather see them enjoy the benefit of having access to that capital. And I'll be able to change the documents then to enable them to be able to receive those benefits.
I think I'd add to that, it used to be the case that a lot of the trust documents that we are talking about were quite rigid, and it's done, and you can't change it at all. More modern trust documents have a variety of escape hatches, which allow a trustee or the original person who set up the trust to make certain modifications. The trustee would give, the initial trust, as Noah just described, might not give outright assets to kids, but it might give the trustee the power to make distributions to kids if the trustee thought that was appropriate. There are often provisions in trusts which give the trustee the right to amend the documents to take advantage of certain legal things that might come up. So I think most modern documents do have, to respond to the original question, some escape type hatches built into them. So you don't find that, I did a brilliant action in 2025 to get ready for 2026. And then in 2027, it looks like I never should have done that. So there are ways to modify going forward.
Thanks, Peter and Noah. If anyone has any questions, additional questions, you can raise your hand like shown here, or just paste the question in the chat. We do have a little bit more time, so just feel free to add a question. I do have a question if no one has a question here, which is, what happens if I end up gifting more than my exemption before 2026?
Oh, great question.
That's a good one.
Yeah. Let's just say your family has $100 million net worth and you've decided to take advantage of the 26, married couples taking advantage of the $27 million exemption amount, but they also want to eliminate the estate tax on the balance of their estate because they know it's going to grow during the remainder of their lifetime. And maybe they want to give 60 million of their assets to their beneficiaries. They'll pay the tax now on the amount that's over the exemption amount. I would share that that's incredibly uncommon because most families will utilize the exemption to the fullest extent. They'll then utilize the annual gifts to the fullest extent. And then there's other two loopholes that we didn't talk about today, which are you can pay education expenses directly, and that doesn't count against your exclusion or your gift. So maybe oftentimes those children are in private school or their grandkids are in private school. If you pay the school tuition directly to the school, you can't write a check to your child to pay the tuition or reimburse them. You write the check directly to the school. That's an allowable gift in addition, and also medical expenses. So again, some families, they will have a special credit card where grandma and grandpa are going to, pay off that credit card, and it's only going to have medical expenses on it. And then the next thing they would do is utilize certain estate planning strategies which don't require an exemption.
Right.
One of them is where you might gift assets. Let's just assume you're going to take the other 30 or 40 million that you want to give to your beneficiaries, and you're investing in highly appreciating assets. What you might do is put the assets in a trust, but the trust owes you $40 million because you contributed $40 million worth of assets. The trust owes you $40 million. So now you have a note payable that's included in your estate, but hopefully the $40 million in the trust is growing at 10%, and the note that is owed to you by the trust is growing at the applicable federal rate, the AFR, which right now may be closer to 4.5%. So your note is growing slower than the assets you gave them. So eventually when you die, they could pay off that note, and basically you've been able to capture a lot of the upside in a trust document.
Samir, I think there may be another application of the question you were asking, which sometimes goes under the heading of, well, is there what's called a clawback, which would be the gotcha, right? So, okay, it's 2025. There's a $13.61 million exclusion. I take advantage of it. I move the assets, and then I die in 2026. Is someone going to say, well, you died in 2026. It's only 7. There's no clawback. Just so don't not take action because you think you're going to get caught by the gotcha. You want to take advantage of the available exclusions as they exist from now until the end of 2025.
Got it. That's actually very helpful to know, especially because you don't want to deal with the clawback. Now, I do have another question since we have a few minutes, which is, you assume we all want to have the best and happiest marriages in the world, but with SLAT specifically, are there any risks with doing a SLAT, especially if you're dealing with something like a divorce?
Yes. And that's something we always raise with clients. In fact, in many cases, when the wealth was created by the couple during the term of their marriage, and there's no premarital agreement or premarital assets, it actually can be a really useful tool if you do get divorced, because you've already done the asset division and you've essentially, formed both trusts, and likely they were funded somewhat equally. So when you get divorced, if the only assets in your family are husband has a trust for his benefit, wife has a trust for her benefit, they can each walk away with those trusts. So it can be a significant benefit. If one person had significant assets before the marriage and now they're trying to do this planning, I'll give you a good point. I used to be in the divorce business and help people negotiate prenuptial agreements. And so in one of the prenuptial agreements, what I noticed was the husband had a large estate, the wife had no estate, and the wife had no reason to use her exclusion amount.
Right.
So what I suggested was, hey, the wife was looking in this instance to just make sure her kids were going to be okay and get something if her now husband was to die prematurely, and she didn't want to be left with nothing. So he acquired a life insurance policy to which she was the beneficiary of, and her children were remainder beneficiaries. And in exchange for acquiring this life insurance policy, she gave him her exemption. And so he was able to then fund a trust. He gave her assets. She then funded a spousal lifetime access trust for his benefit. So basically, he was the beneficiary of a trust that came from assets that he had gifted to her. And in exchange, she got some life insurance to give her comfort that she was in a good position.
Wow.
And maybe we should just mention, it's a whole nother subject, but a component of estate planning can be life insurance. And so there is some complexity to estate planning, and while life insurance isn't inexpensive, can be simpler. So it can be some people just have a certain toleration for estate planning, and it might not completely solve their estate tax problem. And you should at least look at, maybe I can close the gap if I'm still exposed by using life insurance. Just not the only tool, subject to what some insurance people might say, but a good tool to use sometimes in this situation.
Got it. Now, we do, Peter, have people tuning in from different states, right? So the question I would have is, how does federal estate taxes interact with state estate taxes? And should I care where I'm at based on this?
100%. So the short answer is, wherever you live in the United States, you're going to be subject to the federal estate tax. Whether or not you are also, in addition to that, subject to a state estate tax, that's a tongue twister, depends on what state you live in. So there are many states that have no estate tax whatsoever: Florida, Wyoming, Nevada, could go on and on, New Hampshire. One of our guests is from New Hampshire. And other states have estate taxes ranging from 5 or 6% in some of the eastern seaboard states to California, which I think is like 13 or something like that. So, and that introduces, so take New York, for example. It has an estate tax, but and it has an exclusion, but the exclusion is less than the federal exclusion. So in doing this planning, you've got to kind of think through, how do I get the ball through 2 wickets? Well, what do I do to get it through to avoid the federal estate tax and then also the state estate tax? Or, depending upon how you want to live your life, you can move somewhere where there are no estate taxes, and many people do that.
Right. Right. Well, thanks for that. If anyone has any additional questions, you can post here. We do have a couple minutes. If not, though, we'll still look for the questions here. We appreciate you listening on estate planning. If we could go to the next slide.
Oh, good.
So we are having our next Thrive Talk, as you can see right here, and it's an important one because we're going to be talking about the election results, which we should have our election results by then. So on November 12th, you can join myself.
That may be wishful thinking, but let's hope so.
Right? You can join myself, Kyle, Peter, and Noah, where we will be covering post-election, what that means for your portfolio, what that means for taxes, what that means for future policy. And you can register by simply just putting your phone. You can actually just put your phone and scan that QR code right there. Or alternatively, our team will put the link in the chat here so you can register. And we'll send you a follow-up with this recording where you can register as well. But it's really easy to just click the QR code. But I know everyone, especially as a business owner and entrepreneur, is on the edge of their seats with the election. So we're looking forward to coming and hopefully help you have a smooth transition into the next president. Peter or Noah, why do you think this is an important one to attend?
Well, go ahead.
Maybe I was going to say, everyone's going to react to whomever is elected, and their reaction may be favorable or unfavorable emotionally. But what we want to focus on is the policy and how the policy is going to drive performance in the economy and predominantly in the publicly traded investment markets. And also in the private markets, for those of us that own businesses, it's going to impact our tax code one way or another. It's going to impact the investments that we're making one way or another. And so we really just want to shine a light on where we believe that next president is going to make an impact that is going to flow down to us in our personal balance sheets and take advantage of whatever course the country is going to be going in.
And I would say, in contrast to, since neither of the candidates have really said anything about the estate tax, it's difficult to prognosticate too much about that. But a bunch of other things, income tax rates, capital gains tax rates, things like tariffs, which might affect the value of certain types of companies. Both parties are on record in favor of certain policies in those areas, which will have an immediate impact. The estate tax doesn't take effect until you die. Those things could begin to take effect right away. So I think it's we can probably be more zeroed in on what some of the likely impacts of the election are once we know who the next president is and what the likely division of the Congress is.
Right. And I know, Noah, you sent out a note to your followers a few weeks ago about sort of this pause on the election. You guys have both been across the country meeting with different entrepreneurs and seeing a little bit of the pause and hesitation because the anxiety and fear is there. Anything, Noah, even before that you would add about people that are just fearful or putting things on pause because they really just are that scared, especially as a business owner with a lot of businesses in some capacity struggling, right? So would love any advice you could give to our audience here as a takeaway before we close out.
I think a lot of that fear is the fear of the unknown. And if they were to take a look at their own situation, I think the scenario planning that we've been looking at, and Kyle and I were on a call today with a client around their portfolio. We've already been seeing adjustments in what companies we're investing in, what companies we're selling, what companies are moving in the markets based on where people think these election results are going to go. And so I think individually, as a business owner or as an investor, we've got to plan for both scenarios. And so I think it's important to just take a look. Don't be paralyzed in taking inaction. Rather, take the action to learn about the impact it might have on your personal situation, one way or the other, so you're prepped and ready.
Right. And the exciting thing is with WealthThrive is we're going to be there along the journey for you. So you'll be able to see your favorite third generation CPA. You'll be able to see Peter. You'll be able to see a lot of the content that we're putting out to guide you along that journey. But we wouldn't want you to miss out, so you can register today and stay ahead of those upcoming changes. And if you would love to meet with our team, I know Peter would be more than ecstatic to talk to you about estate planning. So we'd love to meet with you.
Terrific. Thanks, everybody.
Great. Thanks, Samir.
Appreciate your attendance, and look forward to helping you.
Thanks.
Thank you. We'll see you on the next
Thanks.
drive.